Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with part 2 of a 3-part video series on FHA mortgage insurance. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of FHA guidelines. Also, this video was issued on May 15th, 2018, and the information contained in this video is subject to change without notice. In part 1, we talked about the 2 ways that mortgage insurance is charged by FHA. The 2 ways are it's charged as an upfront mortgage insurance premium, and then it's charged as an annual or periodic mortgage insurance premium. For the rest of this video, we're going to focus on the upfront mortgage insurance premium, what it is, how to find it, and how it's calculated. So let's take a look at some of the calculations. I mentioned in the previous video that to find what the rate or the upfront mortgage insurance premium amount is, this can be found in Appendix 1.0 of the FHA Single Family Housing Handbook. Now, I'm sure most of your loan origination systems already have this calculated into the system, but just wanted you to know the source from where it comes from. Here's a quick snapshot of what the actual Appendix 1.0 looks like. Let's take a closer look at this. So here is the Appendix 1.0 mortgage insurance premiums. And at the very top, we're going to focus on the upfront mortgage insurance premium, known as the Ufmip. And let's take a closer look at this. So you can see here at the top, it says that all mortgages, so for all mortgages, the upfront mortgage insurance premium as of today is 175 basis points or 1.75 of the base loan amount. So that's the calculation, and I'm going to show you how to calculate it in just a second. There are exceptions, which again we talked about in the first video, for certain exceptions for streamline refinance. So that's when refinancing an FHA to another FHA. There are some exceptions as to how much is charged in the Ufmip, Hawaiian homelands, and Indian lands. But we'll talk about that a little bit. Let's focus right now on all mortgages and the 175 basis points. So here's a basic example. Let's say you have a sales price of $100,000. You would first calculate the base loan amount. And how you calculate the base loan amount is you just deduct the down payment, which is 3.5%, to get whatever the base loan amount is. So $100,000 times 96.5% would be $96,500. Then you'll calculate the Ufmip. Well, in this case, we're using 175 basis points. So how you would calculate that is you would take the base loan amount times 1.75%. And that actually turns out to 96,500 times 0.0175. And you should get $1,688.75. That's the one-time upfront mortgage insurance premium. There's one more step. You got to round down. Remember, drop off the cents. So you would take off the 75 cents and just make it 1,688, which would make your total loan amount, what the borrower is financing, $98,188. So you get that by taking the base loan amount plus the Ufmip that you just calculated. Now, I mentioned earlier that there are some exceptions to this, and one exception is that if a borrower is refinancing an FHA mortgage that they currently have to another FHA mortgage, however, that mortgage was endorsed, basically it was done on or before May 31st, 2009. Now, there aren't many of those left, but there are some of them. And in that case, then the mortgage insurance premium, the upfront mortgage insurance premium that they're going to be charged is not 175 basis points, it's 1 basis point. So definitely, if you've got people that are in this situation where they can take advantage of this, it's a great opportunity. Again, not many of them left, but you just have to be mindful that if you're refinancing from an FHA to an FHA, make sure you take a look as to when it was originated, and if it was on or before May 31st, 2009, the borrower gets the benefit of that much, much lower upfront mortgage insurance premium. And then the other exception was on the Hawaiian homeland section. So you can see here they're basing this on the term of the years. If it's less than or equal to 18 years, they're going to pay 2.4%. If it's financed, if it's not financed. So just make sure if you have a Hawaii property that you're looking very carefully at this table. All right, that concludes part 2 of this 3-part video series. In the next series, we're going to talk about the annual fee and how that's charged and calculated. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. Have a great day. We'll see you next time.